G'day, property navigators. Today, we are going to discuss how investors can make back all invested capital plus profits within the first 3 years or less. And I'll explain some practical ways on how you can do that today. This is one of the core pillars we established here at Property Navigation, and we call it the 3 year or less rule. If you're in your late 20s or early 40s, this rule is essential for you to effectively accumulate properties in a shorter space of time. The 3 year or less rule packages up what we think property investors should be looking to achieve as a minimum standard. If your expected return on investment is blowing out beyond 3 years, you may want to consider a different property market or deal. Realistically, you want your property acquisition costs plus profits back ASAP, so you can reinvest into another property to keep growing your portfolio. With many investors having different strategies, risk appetites, and goals, we want more of you to learn about return on investment, also known as the acronym ROI. Hence the 3 year or less rule for return on invested capital. This video isn't just going to be about how to calculate ROI, but will instead inform you of the frameworks, planning, and strategies that will have you looking at property through a different lens, a much sharper lens. And I'll explain why ROI can be an effective tool to evaluate and compare the performance of your investments over time. Property investing is evolving, and along with it, more effective tools and strategies. Tracking your ROI will help you determine whether it's time to sell, hold, or reinvest. Investors should consider the immediate performance of their investment property by embracing the 3 year or less rule, and not just buying for the long term. You can do much better. Now, whilst long-term growth is equally important, in today's market, the truth is the majority of Aussie investors will become stuck from accumulating more assets without significant short-term uplifts in the values of their most recent property purchases. What we see at the coalface, speaking with investors every single week, is that they are lacking in planning and strategy. Understanding the financial metric, which is return on investment, could significantly improve the visibility of your portfolio's performance, improving the chances of you building out a portfolio in a shorter space of time using low-risk strategies. So, what is ROI or return on investment? Essentially, ROI measures the profitability of an investment relative to its cost. For property investors, this means understanding how much profit is being generated relative to the money you've invested. And believe me, knowing your ROI can make all the difference in the world between a successful investment and a costly mistake. Now, to my left, there will be a list of initial and ongoing costs, as well as profits. In regards to profits, various factors will affect the profitability of an investment property, such as market trends, rental demand, location, property condition, and personal investment goals. So make sure your research and analysis is spot on. Now, to my right will appear the formula for calculating ROI, which is the net profits divided by costs and multiplied by 100 to be expressed as a percentage. Later in this video, I will present to you a tool we use here at Property Navigation to track and compare properties' profitability over year 1 to year 15, which will be available for you to download so you can level up your property analysis skill set. For now, let's just take a look at a simple example of how to apply the ROI formula for a property held for 12 months. A property is purchased for $600,000, using a deposit of $100,000, which covers all closing costs. The annual rental income is $31,200, and after all expenses are deducted, there is a negative value of $6,000. However, profits also include the capital growth of the property, which was $90,000. Now, combining the rental and growth profits, we end up with a net profit of $84,000, or an 84% ROI. If the property's performance continued this growth trajectory, then in 6 months, the ROI would be a whopping 126%, or $126,000. Now, if you are an investor who is planning to accumulate a portfolio of properties, getting the highest ROI from your investment properties over the first 12 to 36 months is key to keeping you in the game by utilizing and repurposing equity to leverage into more property deals. By having visibility on ROI, an investor can develop strategies and plan when to make their next move, which is incredibly powerful for investors who are in the stage of accumulating assets. Accumulation refers to acquiring the necessary assets an investor will need in their portfolio to generate a desired outcome. For example, 3 to 6 properties over 12 years to produce a passive income of $100,000 to $120,000 in the future. And just for context, there are typically 2 stages that follow the accumulation stage, and we should understand all 3 so we have a clear idea on why this is important. The second stage is the consolidation stage, which is all about adding value to the portfolio through cosmetic renovations, subdivisions, knockdown rebuilds, dual income, or granny flat strategies to manufacture capital growth and cash flow. Debt reduction is the final stage, where some assets may be liquidated to remove debt from the remaining portfolio and release more cash flow. One key takeaway here is to ensure you are not trying to reduce debt when in the accumulation stage. So, why is the return of an investor's money sooner important? And how does this fit into timing a property market effectively to accumulate assets at a faster rate? Everyone always asks, where? But they should be asking when. Timing a property market effectively involves strategically buying and selling properties based on market conditions to maximize capital growth. By analyzing various factors such as economic indicators, supply and demand dynamics, interest rates, and demographic trends, investors can identify opportune moments to enter or exit the market. This includes timing markets for cash flow increases, advantageous for investors to improve their portfolio's yields. A better ROI in the short term directly impacts the ability to accumulate more properties, unless you're rich and you have multiple deposits to splash around, which most of us don't. Expanding your portfolio during the accumulation stage requires profits that exceed expenses. By timing property markets, property investors can increase profits, and I'm not just talking about cash flow. I'm talking about equity mainly here. And if you still think this cannot be done, then I'm not here to change your mind. But I would recommend that you review the tangible results that reputable BAs are producing, such as ours, for their clients by placing them into markets before or at the beginning of a growth cycle. We have a whole video explaining market growth cycles, which you can watch by following the link in the description below. Here are 5 reasons why getting your money back sooner should be part of your investment strategy. In essence, getting your money back sooner allows you to optimize your investment portfolio, manage risk effectively, seize opportunities as they arise, and maintain financial flexibility and peace of mind. The 3-year or less rule and what strategy you should be employing around this. The strategy that wraps around the 3-year or less rule is to release equity to recycle into the next opportunity sooner. The amazing outcome of timing a property market means you maximize not only the short-term profits, but the long-term profits simultaneously through holding your assets over a longer period of time, also known as time in the market. An investor will ultimately experience stronger compounding growth forces due to longer holding periods of multiple assets. Essentially, this is a way to supercharge the results of the buy and hold strategy. Cash flows will also increase year on year as rental income is or turns positive and compounds alongside capital growth. The sooner you can acquire a property and put it into your portfolio, the sooner you can take the rental and growth increases as your own instead of chasing them in the market. Here is an analogy, and this is property investing in an absolute nutshell. It's like getting on the wealth train. The further up the carriages we go, the more money we make. We can jump off the train and we can stop moving, but the market keeps going forward. So we want to minimize the time we're out of the market. It is powerful to know within your strategy when it's possible to reinvest back into the property market. Do you think you could purchase a better asset if you could plan and begin analyzing a market 6 months in advance? Timing markets to capitalize on short-term opportunities as well as long-term? Yes, of course, the answer is yes. Our Property Investor Analyzer tool will now appear on screen as I narrate this example, which is available to download in the description below. A tutorial on how to use it accompanies this download. Now, just watch as some numbers get adjusted and the results that follow. If you want more value, give me a call and I'll run you through it personally. All right, let's get stuck into it here, guys. So why is this important? Well, it's going to show you how to time a property market to get higher growth rates, which will give you better return on investment so you can better forward plan and forecast what you will be doing in terms of your next acquisitions and really determine if the deal is feasible for you. So what we're seeing here is we've got the purchase price of 600,000, deposit of 72,000, which is 12%. We're assuming an interest-only loan of 5% over the 30-year loan term. We've got 106,000 in closing costs. And what we're seeing here is a capital growth rate of 15%, declining down to 6% by year 4, which is below the national average of 6.8% right now. So we're being conservative there with long-term estimates. So if we now move over to the dashboard, we can see in year 1, we've got an 87% return on ROI. How did we get there? Well, we had a $92,000 return, which is 2,143 of net positive cash flow plus the 90,000 in capital growth. So combined 92,143. Now we know the closing costs were 106,000, so we divide the 92,000 by the 106, which gives us an 87% ROI. Now, why is this more important as we move forward? Well, we know at 166% for this particular investment that this equates to 90,000 equity. How do we know that? Well, we know that 80% of the value here is 617,000, or how the banks will calculate equity, minus the current loan amount, which gives us 90,000. So we know to replicate this deal, knowing that we needed closing cost 106,000 here, we would only need to add in an extra 16,000 or 8,000 per year in savings to bring us up to 106,000 to replicate this deal. And that's the power. And how do we forward plan? Well, we know if we wanted 1,000 per week, we know we'll need about 6 of these properties in 15 years' time to give us this. All right, back to the video. Let's take a look at another example. Today, we have Jim Bob, who is aged 30. Jim Bob wants to have a passive income of $100,000 in 15 years or less. Essentially, knowing the return of investment on his most recent purchase will help forecast when Jim Bob's property may have enough equity to recycle and purchase his second investment property. For Jim Bob, this will be around the 18-month mark, where his ROI was a whopping 126%, or 126,000. In this case, based on a $100,000 deposit, which included closing costs. With cash flows around this time turning positive as rental increases occurred and interest rates receded. Jim Bob is in the accumulation stage and wants to accelerate his timeline. He has adequate savings to combine with equity and strong serviceability, helped by the now positive position of his investment property. At month 12, 6 months before his next move, Jim Bob researched and analysed markets to determine his next best move. By watching select markets, his confidence grew, and when the perfect opportunity arose at 18 months post-purchase, he was ready with equity released and finance confirmed. This led to a successful investment property purchase, all because Jim Bob had insight into the performance of his investment portfolio, a timeline and a strategy to reinvest his profits. Over the course of 7.5 years, Jim Bob slowly acquired 1 property every 18 months, totaling 6 properties at the end of this period. At year 7.5, he also built a granny flat on the first property purchased to consolidate on its value add potential. At year 15, he liquidated 1 property, removing a large portion of debt and releasing 100,000 of passive income. And if you missed it, at the start, Jim Bob was 30 when he started, and now he's the ripe old age of 45, with a passive income currently equal to the Australian's average wage. He definitely nailed it. And remember, your phone is always in your hands, and we are just a phone call away if you would like to discuss any of the above in one of our discovery calls. If our 3-year or less rule has resonated with you, then our next video will definitely be of strong interest. It is helping property investors like you better understand how market cycles operate and how to determine which indicators are most important to determine when to enter a market of interest. Until next time, happy property navigating.